on Sky News Business. This is Switzer.
Hello, I'm Peter Switzer. Welcome to the program which puts you in touch with the best and brightest minds in the business. On tonight's show, Switzer Super Reports Paul Rickard and Medallion Financial Group's Michael Wayne joined the program for the latest market analysis. Where does the market go? Now it's above 6,000 on the ASX 200 index. And full speed ahead, the automotive industry is showing healthy growth. Car sales CEO Cameron McIntyre joins me on the program. Now, Australian shares struggled under the weight of two of the major banks trading ex-dividend today. Despite the efforts, the ASX still couldn't finish in the green. For more on what drove the local market this session, I'm joined by Switzer Super Reports Paul Rickard and Medallion Financial Group's Michael Wayne. Guys, thanks for joining us.
Thanks, Peter.
Let's kick off on the banks, Paul, and this is your beat. ANZ and Westpac went ex-dividend today. Well, the fact that we didn't drop by much, was that a pretty good sign?
Yeah, I'd say the market gets an 8 out of 10 for today's performance, given the slightly negative lead from Wall Street. We've also got the political uncertainty down in Canberra. You say that's got to be a negative for markets, although maybe that's not what the market's looking at. But as I said, yeah, ANZ going ex its 80-cent dividend, Westpac went ex a 94-cent dividend. You add those back and you'd probably find the market was actually up a few points. So I'd say it was a reasonably strong performance.
Mike?
Yeah, look, it's a continuation of the good run that we've seen. We've managed to breach the 6,000 level and now we're consolidating, which I think is a little bit healthy. I don't think we want to see us sort of shoot away too quickly. The fact is, although earnings revisions are coming out to the positive, to the upside, the vast majority of the rally that we've seen has been a pure shift in sentiment. So I think the ASX has lagged a lot of the international markets, as everyone knows, this year. Probably got out of hand a bit too much and we're playing a bit of catch up now. So I do expect that we can push on a little bit further, but nothing too much, nothing too crazy really.
Why the sentiment shift?
Look, it's difficult to say. I think we got through reporting season unscathed. The US reporting season's been quite good as well. We've had this global synchronised growth that everyone's been talking about, and there aren't too many clouds on the horizon. Commodity prices have been fairly strong as well. So it's been a fairly positive sentiment globally. So I think that's really flowed through to our market.
Paul, sentiment?
Yeah, I mean, we've moved, I think, from the sceptical stage, Peter. Maybe a little bit of optimism now reigns in Australia. We're not euphoric, but you have to say that the last 300 index points, really from 5,700 up to 6,000 and a bit, without too much of a break, has been pretty positive and no signs it really wants to retrace quickly. So I think people are a little more optimistic, I think, sort of querying why we haven't moved before, and now seeing that, well, maybe it's about time for Australia to catch up. And I think the big change also has just been in resource prices. I mean, that's been the big change in our market this year. They've actually seen strength come back into the major miners and energy producers on the back of a higher oil price, and that's provided the sort of added impetus the market needed to move higher.
Yeah, we also had the seasonal factors. October is traditionally a very strong month for the market, a lot of dividends.
So you guys react to that kind of thing? It's seasonal, better buy stocks?
Oh, no, I think it's more that what happens, a lot of companies pay out their dividends, although they might have gone ex-dividend the month before. That cash physically hitting people's accounts comes through in October, and a lot of the institutions, a lot of the private investors will put some of that money to work. That's one of the reasons, not the entire reason, but it's certainly something I think that's played out consistently over the last 10 years or so.
Paul, before we broke 6,000, people said, well, if the banks don't participate in this rally, because the commodity price rally was helping the stock market, we never break 6,000. Why have the banks been marked up again, particularly CBA?
Well, I'm not sure they have been marked up.
Well, CBA was 73.
CBA has been marked up, yeah, and it's, well, not 85, but 81. It's been marked up.
You see, he's long CBA.
But we've gone up. You know, if you actually look at the last 3 weeks, you'll find the banks have lagged the broader market, and that's, I think, really a function of oil price and resource prices, and a lot of the fund managers looking for the so-called growth stocks. So that, you know, in healthcare, some of the industrials. Some of the sort of the second tier stocks that have shown, you know, good growth track records, so they've been bid to sort of pretty high prices. The banks have moved, but it's been just a touch disappointing. CBA is obviously just part of their correction. I mean, it went down on nothing. When I say nothing, it went down on valid concerns over Austrac, but oversold possibly, and it's just recovering. I mean, their quarterly update last week was okay, but it was mainly on the back of bad debts, big fall in bad debts. And
it's a good sign, really.
It's a good sign. You know, banks aren't doing it tough. You know, when you're getting 11 basis points is what their effective percentage of gross loans written off as over a quarter. It's tiny, you know, and so bad debts, you know, impaired assets are all-time lows, and there's no signs of that turning. So, you know, the banks are going to be able to continue to spin out these sort of profits without doing too much hard work. The challenge they have, Peter, is can they grow it? And really that's the issue at the moment, is there is no revenue growth, there's no pressure on bad debts either, there's now no pressure on capital. What they've got to do is either cut cost or work out a way to grow revenue.
Can they grow revenue?
Look, it's going to be a lot more difficult in this environment. The housing market softening. APRA's cracking down on the amount of investor lending, for instance, and household lending in some respects as well. So without the big explosion in credit, it's very difficult for housing prices to keep rallying. It's very difficult for banks to continue to grow their net interest margins at the rates that we've seen in the past. So it's going to be a lot more challenging environment for them to grow their revenue. It's one thing to cut costs, but at the same time, some of the banks at the moment are being forced to invest in technology upgrades. CBA perhaps is a little bit ahead of the game when it comes to those sorts of things. So they're going to get squeezed on a couple of different measures at the moment. So when it comes to the banks, I'm pretty neutral at the moment. I think they're more of an income and dividend play, and you can expect maybe a little bit of capital gain as the cherry on the top. But if you look at the performance of the banks going forward, any share price movements is really going to be driven by shifts in sentiment as opposed to any massive earnings growth. So CBA has lost its big premium that it had to the other big three banks at one point in there, so it might be worth looking at them if they can get through this investigation unscathed.
Yeah, I think what we've seen in the last week or so with CBA is get a little bit of the premium back again. You know, if you look at the actual results we got for the full-year results for both ANZ, or for the three majors, ANZ, Westpac and NAB, they were all a bit on the disappointing side. CBA was actually a little better than expected. And so the market's saying, well, yes, there is still a bit of power in the brand. Sure, it's got to get through all these issues with AUSTRAC, it's got the APRA investigation into its conduct, it's got the class actions potentially to get through. Who knows whether they'll take 6 months or 2 years to unwind. But CBA's regained a little bit of the premium that it lost in that sell-off, and I think that's what you're seeing.
Mike, 6,000, is it going to be a support level? And if we can rule out something really scary from overseas, do you think this market's going to keep crawling up from 6,000? Look,
that's my feeling. I don't think it's going to happen overnight. I think the big gains that we had through October and the early stages of November are going to be the majority of it for now. I think what's been encouraging, it's been quite a broad-based rally in that it's been the smaller mid-cap stocks that have been helping drive the market high. We haven't necessarily been relying completely on the big four banks, which has been the issue in the past. I would like to see it consolidate. Some of the valuations are becoming stretched. For example, the price of your small caps or your mid caps relative to your large caps is very, very stretched by historical measures. So you want to see things sort of settle down. You want to see at least the earnings revised higher. We want to get through the AGM season, which we're currently in the midst of, just to make sure everything's okay as we lead into the end of the year. But I do think that can be a support level going forward, barring anything unforeseen.
Paul, you know, I shared with you today in the Switzer Super Report the history of long streaks on the US. It's quite an extraordinary piece of info, wasn't it?
It is, Peter. You wrote a very bullish assessment about that. Yeah, I mean, you're the glass half full guy. So, but yeah, it is. Look, there's no reason why this market has to pull back. Markets pull back because, you know, all sorts of things, and we find excuses. But markets don't have to pull back, and the same with the US. I mean, you know, there's no rule that says that just because you've rallied for 50 months doesn't mean you can't rally for another 10 or 12 months. And you know, so those sort of arguments, I think, is what you're pointing out, don't always hang, you know, there's not a lot in those arguments. They're more looking at history. So I think, you know, our market, we need positive lead from the US, which we're getting. We need that to continue. But we probably also need to see this consolidation around 6,000 first. I think it's been very impressive so far, the fact that it hasn't just gone up to 6,000 and immediately popped down the downside again. It's actually sat here. I thought today's was good price action. We need to see more days like that first to find a bit of a base to say that, so that almost 6,000 can become a support level.
I know it's hard. Both you guys have said it's hard finding good value at the moment. But have we been overexcited by Amazon's effect in the short term, and therefore is, say, JB Hi-Fi at $23.30 a reasonable buy for 6 months, roll across the February show and tell? What do you think?
I think it's difficult to say. That's the thing. I think JB Hi-Fi, you can throw in there Harvey Norman as well, and they're both very high quality businesses, and looking at them on today's numbers, the valuations are very compelling. They've got good earnings growth, there's been good dividend support. Amazon is going to come into Australia, but it's very difficult to work out the timeline of their entry, the size of their entry, and the overall impact. Obviously, companies like Harvey Norman, JB Hi-Fi have a very good distribution network throughout Australia. It's going to take some time for Amazon to build up to that level. But I think in the end of the day, it comes down to sentiment again, because JB Hi-Fi, Harvey Norman, regardless of the numbers that they put out, their shorters are just shorting them time and time again. So I don't think there's any great urgency in that space, but they are both high-quality businesses. But it's also worth pointing out as well, they have had a number of tailwinds in recent years. Low interest rates, the housing boom that we've just gone through, a lot of construction and new apartments coming online that are being decked out with the latest tech goods and electronics. So that tailwind's probably disappearing as well, somewhat, and that's been flagged by the likes of the JB Hi-Fi CEO. So very high quality businesses, but there's no urgency, in my opinion, to be getting into them straight away.
Cool.
Look, I'd love to say JB Hi-Fi is a great contrarian buy, Peter. I am just wary of the short sellers. Short sellers, we know, have deep pockets and can be incredibly patient. And we got a little bit of news that we know Amazon is coming at some stage, whether it's really much more than just a Melbourne warehouse this year and something next year, who knows. But my guess is the short sellers aren't going to go away quickly. And so I think if I was looking for performance, I'm not sure that's the stock I'd be rushing to invest in just yet. But, you know, maybe, you know, in a bit of a dip in the market, it might be worth having a look at.
What about Domain listing on Thursday? What's your take, Mike?
Look, it's a space that's been doing very, very well. Look at the performance of realestate.com, and perhaps you can draw a bit of a bow between the two. If you look at sort of these divestments over the last few years, more often than not, they've performed quite well. You look at sort of S32, you look at things like Aurora or Clydesdale Bank. So perhaps Domain will be another one of those. Their most recent update was fairly strong, although the update from realestate.com was equally as strong, and it almost showed that they're taking market share in some of the space that Domain's meant to be quite dominant in. So my preference is still for REA, but I would like to see how it comes on Domain as how it starts trading, because it could be one worth looking at. Potentially even sort of, if you do have some realestate.com, selling a portion of that and putting it into Domain. But it's an interesting IPO. That's
yeah, the history of these demergers, and we're generalising, typically they don't do very well initially, but they do well after a few months. So there tends to be, because every Fairfax shareholder on Thursday is going to suddenly find they've got some Domain shares. And so there's probably going to be a little bit of forced selling over the next couple of months. And so typically they tend to come off for a couple of months, and almost a bit like a U-curve, the old J-curve that Treasurer Paul Keating was so fond of in terms of describing what was going to happen when the Aussie dollar fell in our balance of payments. So it's a bit like that. That over the medium term they do well, not so well in the first couple of months, but it may be worth having a look at in a couple of months' time, just to see what sort of forced selling there is. It'll take a while for the market to establish a price, but if you recall the last thing, South 32 came off, CYB came off for a while until it sort of suddenly found a bit of value and a bit of flavour. I think Domain is a very different business to REA, and I'm not sure REA shareholders are necessarily going to sell out their chips there and buy a somewhat cheaper Domain. So if Domain is priced at too close a multiple to REA, then I think it's going to come under a bit of selling pressure.
Okay, I'm not going to let you guys get away without giving us your best investment idea right now. Mike?
At the moment, looking at Janus Henderson Group, I've sort of mentioned in the past things like Altium and Platinum, they've run pretty hard. So when I'm looking for a bit of value in this market, it's not that easy. So Janus Henderson, they're a diversified fund manager. They've recently done a merger between Henderson and Janus in the US, and that gives them a nice distribution channel into the United States. They had the first quarter of inflows since the Brexit. With their most recent update, they've had about 80% of their funds outperforming over 1, 3 and 5 years. And it trades on about 14, 15 times earnings, when the likes of Magellan, when the likes of BT trade, and Platinum even trade on around sort of 20 to 22 times earnings. So I think there's some relative value in something like Henderson.
Yeah, but Janus is kind of famous for bonds. Henderson is not just bonds.
That's right.
Are they more diversified now because of the merger?
Yeah, they're far more diversified. They have about, I think, 50% in equities and about 30% in fixed income. And Janus is very famous for fixed income, as you say, through Bill Gross, the famous bond king, the guy that started PIMCO. So that sort of network is a good diversification tool for them in geographical sense, because in the past Henderson had a very strong orientation towards Europe and towards the UK. That was seen as a big negative with the Brexit, the uncertainty that was creating and the falling pound. They've managed to diversify themselves away from that now, and I think that over time the money will start to flow back their way.